My name is John Skelton. I'm with apexinvesting.com. Apex and Nadex, two separate companies. Nadex is an exchange. Apex, we're an online group of traders helping traders. I'll tell you a little more about us here in a minute, but we do these educational webinars each and every Monday evening at 7 p.m. Eastern Time. So I appreciate you joining us tonight, and hopefully you'll look forward to having y'all join us every Monday hereafter. If you've been with us for a while, you know we cover all kind of different things. We cover some basics of Nadex binaries and spreads. We talk about how to use them, how to trade them, different trading strategies, different applications, different ways to use them. Over the last couple weeks, we've kind of started over and recovered some of the basics. I think like 3 weeks ago, I did the basics of Nadex binaries. What is a binary? How does it work? You know, basically, if you were brand new to Nadex or brand new to Nadex binaries, you didn't know what they are or how they worked, that's what we were covering. Like from, you know, let me hold your hand and walk you through it from elementary school type of thing. Here's the basics of a binary. Then the week after that, we did basics of Nadex spreads. What is a Nadex spread? How does it work? And so we knocked out kind of the basics, and then last week we reviewed how to pick the right binary, because there's so many different binaries. It's like, hey, you understand what a binary is and how it works, but there's so many different ones. Let's go through and explain why there's different binaries, why choosing one binary over the other might be better, might be worse, depending on your strategy or system, why there's different ones, why they're priced differently, and so on. And that's kind of what we're going to do this week about Nadex spreads, okay? And Ezra, you already asked a question about calculating how spreads priced in comparison to the underlying. We're going to talk about some of that. And I'm going to actually pull up some charts, and we're going to show some examples and kind of help, you know, put it to practical use on a chart as well. So that's what we're covering tonight. Is we're going to talk about some common misconceptions with Nadex spreads and how to pick the right spread. All right, so that's what we're going to be doing tonight. We're not going to be digging into strategies and systems and, you know, indicators and how to trade different strategies. We're going to be talking about how to pick the right spread. And you might have a great strategy, you might have a great system, but if you're choosing the wrong instrument, if you're choosing the wrong spread, it might just not be working for you. And I've heard some people say, well, those spreads sound great and I really like how they work, but they never work for me. I always get in a spread and the market moves and I don't make any money. I don't see my P&L moving. Like it's not working. Just like some of you last week were like, I always buy these certain binaries or sell the certain binaries and the market goes my direction, but I don't make money. Well, we talked about that last week, how maybe you're choosing an out of the money binary that's just too far away. And even though you're right and the market's going your direction, it's too far away, you need to choose a different binary and it'll fix your problem. That's what we want to address this week about Nadex spreads. Just helping you to see that there are several different ones and why you might possibly be choosing the wrong spread, or maybe just the wrong spread for your strategy, or you just simply didn't understand how they work, and we want to clear that up for you and teach you a little something to look out for that you can put to use right away tomorrow for trading, or right away tonight trading after this webinar. So let's get our disclosures knocked out here so we can get rolling. Trading futures, options, or any financial instrument involves risk, may not be suitable for every investor. Information here in this webinar is for informational and educational purposes only, not an offer or a solicitation of an offer to buy or sell any particular financial instrument offered by Nadex. Past performance not indicative of future results. If you are brand new to Nadex, make sure to hop on over to nadex.com. You can go through some of the tabs there and get some more information about the two products that Nadex offers. They offer binaries and they offer spreads. Okay, you can also go into the webinar archive there and catch up on some of the last few weeks of webinars if you might have missed them. If any of you are joining us tonight that you were not here a couple weeks ago for the basics of spreads, I'm going to do a quick review of some of the basics, but if you really want to dig in and make sure you have a good handle on the basics and you missed it, you can just go into the recording archives there on the Nadex website and you can catch up on some of the past webinars. From there, you hop on over to our site as well. You can go to apexinvesting.com. We have a ton of free education there. You can sign up, get a free username and password, literally go through hundreds of hours of free education. We have step-by-step training courses and trading systems for binaries and spreads. You can check out those different strategies and systems. We have some news calendars, some free deviation levels, some free binary and spread scanners. We show you how to get free charting information, free futures and Forex data, all kind of great stuff over there. So make sure to take advantage of that. Also, when you're on the Nadex website, if you don't have one already, make sure to sign up for a free demo account. Nadex will give you a $25,000 free demo account. That way you can play with demo money, getting familiar with the platform, entering and exiting orders, test out any new strategies or systems. A lot of free tools available to you if you're a Nadex trader. You can get the free demo, you can get all the free education over at Apex Investing. So definitely don't just jump in and start throwing live money at something when you don't know what you're doing. Make sure to take advantage of all the free tools and free demos and free education that is given to you. While you're at it, hop on over to facebook.com/apexinvesting. Like us and follow us on Facebook. Once you've liked us on Facebook, you'll see a button here that says liked. If you click that, it'll open up a little drop-down menu. Make sure you select all posts. That way you get all the notifications. It's a great way to keep up with what's going on. We'll post new strategies, new systems, trades from our trade room, any upcoming webinars you need to know about, any big news events you need to know about that might affect your trading. A lot of cool stuff that we post and share on there. It's a great, easy way to keep up to date of anything new or anything you might need to know. So like I said, tonight's topic, common misconception with Nadex spreads, how to pick the right spread, understanding spread, premium, and pricing, and how to quickly figure risk and reward. So let's just do a real quick overview of spreads here, because I want to make sure you got the basics down, and then we're going to take the basics kind of to the next level here. Okay? On Nadex, you can trade Nadex spreads with stock indices, future commodities, and Forex pairs. Basically, they're called a spread. We like to call them box spreads, because if you draw them on a chart, they look like a box. Spreads have a top and a bottom, or what we call a floor and a ceiling. All right? So for example, let's say this was a spread on the euro dollar. Let's say the floor or the bottom of the spread was 1.2400. Let's say the top of the spread was 1.2500. So the spread is the difference between the floor and the ceiling. In this case, that's 100 pips. All right, so it moves in pips or ticks. Pip is the last digit quoted. So each pip is worth $1. Spreads are not like binaries. It's not like all or nothing. It's not 0 or 100 at expiration. Spreads mirror the underlying market as the market ticks up or ticks down, and each tick or each pip is worth $1. So there's 100 pips in this particular spread. So let's just look at an example if we're selling. Our strategy, our system, our charts, our indicators, whatever we're using, are telling us that the market's going down. We think the market's going down, so we want to sell. Well, if I sell and the market goes down, I don't make additional money below the bottom of the spread, below the floor of the spread. If I sell right here, again, 2400 is the bottom, 2500 is the top. If I sell right in the middle at 2450 and the market goes down 500 points and I'm right, it went way down, I'm only making money to the bottom of the spread, to the floor. But if I'm wrong and the market goes against me and it shoots up 200 pips, I cannot lose additional money above the ceiling. So the floor and the ceiling cap my profit and limit my risk. So let's take a quick example here if I was to sell. Let's say I sold at $24.90. That's the price I sold at. It's $24.90. Well, the top of the spread is what? The ceiling is 2,500. I'm selling at $24.90. So what is the difference between where I sell and the ceiling? Well, 10 pips, right? So only 10 pips from $24.90 up to $2,500. So each pip is worth $1. There are 10 pips, so my cost and my maximum risk is only $10. Okay? There are 90 pips of profit potential to the floor, right? Because I sold at $24.90 I can make money all the way down to the floor of 2,400, which is 90 pips. And each pip being worth $1, I have 90 pips of potential profit. Okay? Let's look at the opposite. Let's say we were buying. Again, I can't make it. If I'm buying, I'm saying the market's going up. Well, I can't make money above the ceiling, and I can't lose any additional money below the floor if I'm wrong. So let's say, for example, I bought right here at 24.10 because I think the market's going up. Well, the difference of 24.10 compared to the floor, which is 2,400, is 10 pips. Again, each pip being worth $1. There's 10 pips or $10 of maximum risk. And again, I've got 90 pips up to the top, to the ceiling. So I've got 90 pips of potential profit, each pip being worth $1, so a potential of $90. Now, those are just some examples there. I can buy or sell anywhere in between the floor and the ceiling depending on where the market is or what contracts are available. If I bought right here in the middle at 24.50, saying the market was going up, I would have $50 of potential profit up to the top, and I would have $50 of potential risk down to the floor. Okay? And I can close the spread at any time. I don't have to hold it till expiration. Okay? I can buy it right here at 24.50, and when it gets up to 24.80, I can sell out of it and take the $30 profit if I want. Okay? I don't have to hold it all the way. And just because a spread hits the floor or goes past the floor or hits the ceiling and goes past the ceiling, it does not automatically just close out the trade. Okay, the trade is still open until it expires or until I close it. So for an example, if I bought right here, saying the market's going up, and I was right, the market went up and went all the way to the top. I made the most that I could make on that trade. Well, it doesn't automatically close the trade out. I can close it out right there. But if I leave it open, it will stay open. And look what happened. It came all the way back down. Okay, now luckily it came back up, but just because it hits the top or bottom does not automatically close the trade. All right, I have to close it myself or let it expire. So I can close it at any time. All right, and get in and get out. But if the spread expires, it will close at the settlement price at the time of expiration. All right, the settlement price is based on the underlying market. For example, if I had bought right here at 24.10, yes, the market went all the way up to 2,500, but then it came down, then it came up, and let's say it expired right here at 24.80. Well, what would I have made on that spread? If I bought at 24.10 and it expires at 24.80, all right, 10 to 80 is what? 70 pips, right? So I could have made 90 pips that I closed it out up here. But if I don't close it and it expires, what I make or lose, all right, is the difference of where I got in compared to where I get out. Simple as that. Okay? So that's in a nutshell is the basics of how spreads work. So let's do something here. I'm going to pull up this is the Nadex platform here. Okay? This is the Nadex platform. Okay. Mike says, what is the settlement price again? Is it the price closed at expiration? Yes, Mike, exactly. Right here, you see right here this indicative price when you're looking at the Nadex exchange. See right here, indicative price. Okay? That indicative price is the current market price. All right? That's the Nadex indicative price. Basically, the way that works is what they're doing is they're basically taking the top, you can find this on the Nadex website, but it's basically they're taking the last 25 prices, okay, the last 25 orders. They're getting rid of the top 10 and the bottom 10 and averaging the middle 5, okay, to give you this indicative number right here. That way, and they do that also for like on binaries, because a binary is all or nothing. Okay, and whether you win or lose that binary, it could come down to 1/10 of a tick. All right, and you don't want to get caught in some massive order or some massive institutional order, or one order at the very end bumping that price one way or the other. So it's averaged out. All right, so it's based on this indicative price here. Okay. At expiration settlement price, is there still bid ask or one single price? Enrico, no, you're not paying bid ask spread at expiration, because let's say, for example, let's say I buy this spread right here. Okay. Well, I bought it for 17. I can buy it for 17,811, right now. If I want to sell out of it, or well, now it's 17,812. If I want to sell out of it, I can sell it at 808. At expiration, it's just expiring. Okay, I'm not having to sell it, so I'm not paying that bid-ask spread at expiration. It just expires. What I'm getting at expiration is where I bought in and then where it expires. Now, granted, yes, there's a 90-cent fee, on each side. I mean, you got your fees, but no, you're not paying bid-ask spread. You're only going to pay bid-ask spread if you get out of something. Okay, but if you buy into, a binary or a spread, in this case we're talking about spreads. If I buy into a spread and it expires, well, then I never sold out of it, so I didn't have to sell it to somebody on that bid side. So nope, I'm not paying that. Okay, so right here I have up the Nadex demo platform. Now, let me just do something here. Last week, we were talking about binaries, right? And for those of you that were with us, we were talking about the fact of, okay, everybody understands now the basics of a binary and how they work. Each one of these strike prices right here is a different binary contract. So like at 9 p.m. tonight on the euro dollar, you've got a ton of different binaries to choose from. And right here you see, here's the price you can buy them for, here's the price you can sell different ones for. And we talked about how some of you guys are like, hey, these binaries, I have this great system and it seems to be working, but I always seem to choose the wrong binary, I guess, because I don't quite understand binaries. And if you're with us last week, what we kind of narrowed it down to that we all understand with binaries is, okay, let's say I'm trading the euro dollar. I think the euro dollar is going up, so I want to buy a binary. Ooh, do I want to risk $94 to make $5? Maybe not. Do I want to buy for 82? Do I want to risk $82 to only make 18? Oh, look at this. I only have to risk $8. Max loss $8, and I can maybe make $92. I like that, right? Remember we talked about this. But what are you buying? Where's the market right now? 15.25. What does this binary statement say? The market has to expire above 15.39. So the market has to move up quite a bit just to get to this strike price, right? We talked about how that's not as high of a probability. You have to make sure that the market's moving. You have to know that it's moving up. But a lot of people are drawn to these binaries, these lower priced binaries, because they're low risk. But then you wonder, like, well, hey, why do I never make money with this binary? Because the market was supposed to go up. Like my strategy or system told me the market was going up. Right now it's at 15.25. And I bought this binary and I was right. The market went up. But by 9 p.m. it only went up to 15.35. So it never quite went to 39. So you were right. The market moved. The market moved your direction. The market went up. The market even went up 10 pips by 9 p.m. But it didn't get all the way up there. So you feel like, hey, I'm right. The market is going up. I'm choosing my direction the right way, but I never make money on binaries. And it's because sometimes you're choosing the wrong one. You're choosing one too far out, and the reason you're going for that binary is because you like the low risk. You're looking at the risk. You're looking at the dollar amount down here instead of looking at the reality of how far the market's going to move. And we cleared that up last week, okay? If you missed last week's webinar, check it out on the Nadex website under the archives. That's what we're going to talk about this week with some spreads. Okay, so let's take a look at something here. A minute ago, we were looking at the indices spreads. We were looking at the Wall Street 30. Okay, the Wall Street 30 is the Dow. Okay, everybody's heard of the Dow, right? It's the Dow Jones. It's a indicative of the Dow Jones. So let's look at some spreads. These are daily spreads, okay? Now, you can get spreads that are, like if we look right here real quick on Forex spreads, and let's just go to pound yen, for example. We've got spreads tonight from 6 p.m. to 11. We've got spreads from 6 to 8, spreads from 7 to 9, and we've got daily spreads too. There's all kind of different spreads you can choose from, okay? All kinds. But for our quick example tonight, let's take a look at the, for now let's just look at the Dow. So we've got several spreads, and check this out. These spreads go from, they opened up at 6 o'clock tonight. They don't expire until 4:15 tomorrow. We've got 20 hours, almost 21 hours left in these spreads. Now, markets can move quite a bit in 21 hours, right? I mean, let's just take a look at something real quick. The Wall Street 30, which is the Dow. I've got a chart pulled up here. I mean, let's just take a peek at this. Today's Monday, all right. What did the Dow do? Like in the middle of the night around Europe Open, the Dow was down at what? 17,676. Can you see the price all the way over to the right of my screen? So let's just call it 17,680. And where is the Dow right now? 17,810. So is that like 130 pips today? Okay, 130 pips or 130 points, right? Ticks. Look, let's go back to, let's look at Friday. Middle of the night, where was it? Look at this. It was about 17,780. By 10 o'clock, it was down to 17,6. I mean, what is that? 200 and, or I'm sorry, 780. What, 100? So went down what? 160 points. Oh, look, kept going down to 580. So what? 200 points down. Boom. And then went from what? 570 up to 730. Another 150 points. I mean, this thing can move, right? You know what I mean? Yeah, Sam. Yep. On the Dow, it's 1 pip, $1, 1 point. Yeah. There's no, on the Dow, for example, see it's 701, 702. There's no quarters or anything like that. So, I mean, like, for example, this thing can move, right? So, if we're looking at the Dow, let's take a look at what we've got here. We've got several different spreads, don't we? Where is it at right now? What's the indicative at? 17,811. Okay. So this spread right here goes from what? 17,800 up to 18,200. All right, so 17,800 to 18,200. Let's take a look. Let's look at this chart, 17,800 to 18,200. I've even got to squash this chart to get up there, right? So that's a pretty big spread, isn't it? So that spread goes from 17,800, basically right in there, up to 18,200. So let's say that my chart, my strategy, my system, whatever, is telling me that I think tomorrow the Dow is going to go up. Okay? Well, right now, the market's at what? 814, 810, 810, right? Let me get this back into perspective here. So I'm pretty close to the bottom of this spread, right? like I don't have a whole lot of risk in that trade technically. I'm really close. So where is the bottom, the floor is what? 17.8, right? And the market's at 17.810. So just because we enter the spread when the market's at 17.810, does that mean we only have 10 ticks of risk? What are we looking at here? What can I buy that spread for right now? I buy it for 17.852. Okay, so this is something I hear people say a lot of. Well, I was looking at my chart and the floor is right here, the market's right here, so I bought that spread. But then the market moved up like 40 points, but I only made like 10 bucks. These spreads don't work. I thought it was $1 a pip. Okay, you have to look at what you're buying. Just like on a binary, it's no different. Just like on a binary. Oh man, I bought a binary, the market went up. But yeah, did it go way up here though? You can't just randomly choose any binary to buy it and say, well, the market went up, I should have won. I should have made money. No, maybe it didn't go all the way up here. What strike are you buying? It's not just about buying a binary or spread because you think the market's going up. It's not just about selling a binary or spread because you think it's going down. It's which one are you buying or selling? How far out are you getting? Are you getting the right one? So let's take a look here. So where can I buy this at? Look how close. The floor of this is 17.8. The market's at 17.807. What happens if, how much potential profit do I have in here? Like 400 points, right? $400. Like if the market goes up, I've got a lot of room to be right there, don't I? Right? So I don't have a whole lot of room for it to go against me, do I? Now, let's take a look at something. What if I bought this spread? 17.4 to 18.2. Okay? So 17.4 is way down here. 18.2 is way up there. So I'm getting in kind of in the middle of this, right? If I were to buy this spread, I'm risking my max loss is $405. So I'm getting in the middle. And I can make about 400 bucks. So how much do I have to put up in margin to even get into this spread? About 400 bucks, right? Man, does anybody look at that right there? Ooh, 405. Does that make your heart beat a little bit? Like, oh man, I got to put up a lot, right? Well, we all know that that's just margin that you got to put up. Okay, that's worst case max loss. That's not planned risk. If something's going against you, you're going to get out of it. All right, but you're like, oh, I don't really like that. I don't max loss for. I don't like that. Let me try this one here. If I want to buy this spread, I can. Oh, I only got to put up 49 bucks. I like that. And look, I can make 350. I like that. Let me buy it. That's what you do, right? Just like with those cheap binaries. Like, oh, I only got to put up 49 bucks. Cool. I like that. But what you fail to look at is where are you buying in? The market's at what? 804, but you're buying in at 849. So let's look. What does that mean? Okay. You're buying in right here at 849. So you jumped in that trade because you like that $49 risk. but you didn't really pay attention to where you were buying in. And you were right. The market starts to go up. It's at 804. It goes all the way up to 840. And you're like, okay, well, at the time I got in, the market was at 804. So if it went up to 840, I should have made $36 because that guy on the webinar told me it's $1 per tick, right? But it's not about where the market was when you bought in. It's about where did you buy into the spread. Does that make sense? Is that a little bit of an aha moment? Because I hear it all the time from people. I got in and the market moved like 20 ticks. It only made like $5. Okay, where did you get in? Now, so when you get in here, or when the market's right here, but you buy in here, that's called premium. There's premium built into this spread. Why? Well, that other big spread, you had a big, huge risk, didn't you? You're going to have to put up 400 something bucks and a max risk of 400 something bucks. But if you want a spread that's real close to the floor or ceiling and your risk is real low of only 49 bucks, but you have a potential profit of 350 bucks, that's a pretty good sounding trade there, right? To only risk 49 to be able to possibly make 350 bucks. You're going to pay a little premium for that. Why? Because you're so close to the floor here that you're protected if you're wrong and the market goes against you. You're not taking on that big $300, $400, $500 risk. You have protection. You have insurance because you're getting a spread that's right close to the floor. So you're not taking on a big risk, but you're getting a big potential profit move. You're kind of insured there. And when you have a car that you pay insurance on every month, when you have a house that you pay insurance on every month, what do you call that? I'm paying my premiums, paying my insurance premium, right? That's the easiest way to explain premium is, yes, you're not taking on a big, huge risk. You're only having to put up a little because you're close to this floor. You've got a huge upside potential. There's a little premium built in there in exchange for that, which means you're getting in there. Makes sense? Now, let me clarify. If you buy in right here at 849 and the market's right here, as the market moves up, I'm not saying that you're not going to make any money. You will. Like your P&L will go up. The value of your spread will go up. But it might only be going up, instead of $1 per tick, maybe it only goes up 40 cents per tick or 50 cents per tick or 60 cents per tick. All right? I mean, as it's moving up, you are getting value. You are getting profit. Your spread is becoming more profitable. But at what point do you think it's going to start going $1 per tick? Where you bought in that, right? As it's catching up with delta. Exactly, Sam. That's all it is. It's similar to a delta and an option. That's exactly what it is, Sam. It's that simple. Okay? That's what it is. So does that make a little bit of sense now for some of you that were like, I keep getting these cheap spreads, so I don't have to put up a whole lot. The market, when I got in, it was right here at 805. The market went up like 35 ticks. So I should have made 35 bucks. No, you got in right there. So just like with binaries, you can't just randomly buy one because it's cheap. You got to see what strike price you're getting. The same thing with spreads. Okay? Now let's look at something. Any questions on that in and of itself? Does that make sense? I know a couple of you said, aha. That is an aha kind of moment there. Okay? Mike, don't you have to pay $17,805 but difference? I'm not sure what you mean there. For the Dow, What you're paying or what you're putting up in margin is the difference of where you get in at compared to the floor. All right, that is why right here, spread is 17.8 to 18.2. All right, so the floor is 17.8. Where can you buy it? 17.849. So how much do you have to put up in margin? 49. See it? Because what you put up in margin is not the difference of where the market's at to the floor. It's the difference of where you bought in the spread to the floor. Okay? Now let's look at something. Let's look at, right, Mike, exactly. Yeah, just $49, not $17,000. Right. Yeah, because the bottom of the spread is 17.8. So that's the most we're buying, saying the market's going up. So the most that we can lose, the most that can go against us is to the floor. So what is the difference of the floor, the bottom, compared to where I'm buying in? That's how much I have to put up. That's the same on all spreads. Like, take a look at this one, for example. 17.6 to 18. And I'm buying it at 17.806. So without me even pulling up, you can figure it out now. If we're going to buy, the bottom is 17.6. We're buying it at 17.806. So what we'd have to put up is what? 206. See? Let's pull it up. Bam, bam, 206. Okay? So now that when you know that, you can view these real easily without even having to open the tickets and fill it out just to check your math. It's kind of right there. Okay? But let's take a look at something here. So we saw that there was like 40-something points in premium on this spread, right? To buy it. Well, and we understand why, right? Because we're getting the safety net of low margin, low risk, and high potential. Because the indicative's at 804, but we had to pay 848 for it. But look at these. They're right at 804, 805. They're right on. See these spreads? These are a little bit bigger spreads, right? We have a little bit more that we have to put up, but we're getting in right in the middle of these spreads. So when we get in right at the middle and we're buying it for 804 and the market's at 803, what happens when the market goes up one tick? We're kind of even on right then, dollar for dollar, aren't we? Every pip it moves up, dollar. We're not having to wait for it to catch up with any kind of premium there. Does that make sense? Those are right on. So when you get those spreads that are in the middle, yeah, you kind of have to put up a little more to get them, but you're going to start gaining your dollar per tick right away because it's in line with, you're buying in right where the market is. Okay? Does that make sense? Okay. Sam, it's the Dow futures. Yeah, Wall Street 30, see, June. It's the June contract for the June futures of YM. Yeah. Okay. So, can anybody raise their hand and say, I have done that before. I've always said those spreads sounds cool, but then every time I get into them, like, I don't seem to make money. It moves. Can anybody say, yep, that's probably what I've been doing? Yep, exactly. We've all done it. And why do we do it? We do it because of this right here. We do it because we open this up, or this right here. So we open this one up, we say, all right, we can buy that one, cool. Ooh, I gotta put up 400 bucks. I don't like that. I don't like that. That's what scares you, right? But you have to stop for a minute. Stop thinking like a binary trader. The reason that scares you right there is because you're used to trading binaries. You're used to opening up a binary contract, and you're used to clicking it and going, okay, I'll buy this binary. Max loss 55, max profit 44, come 9 o'clock. And 1/10 of one tick will be yes or no, win or lose, all or nothing. In your head, your mentality is you're used to buying, you're used to looking at that number right there going, I'll either make it, I'll either get it or lose it. Yes or no, all or nothing, right? So it scares the heck out of you when you go over here and you see a number like this going, ooh, 406, yes or no, gone in a heartbeat, all or nothing, scares you. But spreads don't work like that. If you were going to buy, saying the market was going up, what would the market have to do for you to lose $406? Like literally, I'm asking the question, like, let me get feedback. What would have to happen for you to lose $406 on this spread, for you to lose this whole thing? Yeah, the market would have to go down 406 points. Do you know how hard it would be for me to even squish this chart to show 400 points? I mean, it's crazy. Are you going to, if you bought the spread thinking the market's going up and the market dropped against you like 40 or 50 ticks, what are you probably going to do? Say, hey, I think I was wrong. I'm going to get out of it, right? You're not going to sit there and watch it go against you 400 points. If it's gone against you 30 or 40 or whatever, you're going to probably say, okay, I was wrong. Let me get out. So how much did you lose? 20, 30, 40 bucks. If a binary goes against you by one tick, you lose it all, right? You buy a $70 binary, at expiration it goes against you by one tick, you lose all 70 bucks. On a spread, the market have to go against you 70 pips for you to lose that same amount. So don't let that scare you. Don't let this number scare you, because that's not all or nothing what you're going to lose. That's just your margin that you're going to have to put up to get in the trade. It's about planned risk. It's about realistic risk and managing your trade. So don't get scared by that number and therefore, you know, choose a spread that's so far away that it's not, you know, going your direction. Like it's not going to move fast enough. Okay, so don't be scared by that. Don't make decisions based on that number. Like I said, don't let it scare you. What you want to do is look for the right spread. Okay, so again, when you can find spreads that are, see, market's at 803, you can buy into it at 804. You're going to start getting dollar per tick right away on those. All right, if it's at 803 and you don't get into 848, you're not going to get dollar a tick right away as it moving until it gets way up there. Right? So everybody understands premium, right? Where there's some premium built in there. Okay? Now, that is when you're paying premium. You can either pay premium or you can collect premium. What does that mean? Let me clear this chart and let me just show you what I mean real quick. Okay. Where is the market right now? It's at 807, right? Okay. So we know that if we want to buy, we have to buy up at 849, right? Okay. What if we could buy down here? What if we could buy below the market? That would be pretty cool, right? Because what if, just as an example, what if I could buy right here at 760, right now? If I could buy at 760 and the market just stayed flat, right where it is, all the way till expiration. It didn't move, didn't go up, didn't go down. It just expired right where it's at. Would I make money or lose money? Because with the spread, how does it work? It's the difference of where you buy in compared to where you get out, or where you buy in compared to where it expires. So what's the difference of 760 compared to 803? It's 43 bucks. So am I paying premium there, or am I collecting premium there? I'm collecting, right? Remember, if I bought that other spread that was way up here, I'm paying premium. Let's look at something. Where's the market? 803. Where can I buy this spread? 759, right where I just showed you on the chart. But what's the top of the spread? 17.8. So I can only make money from 759 to 17.8. But the market's already above 8. Sam says, how do we collect it as we're buying? Well, Sam, it's right here. Take a look. If I buy it at 759, what's the most I can make money up to? Up to 800, right? But the market's already over 800. So as long as the market stays above 800 or goes up, I would make money from 759 to 800. Or if the market just sat right where it was, didn't move, I'm just letting time go by and I'm collecting the difference from 759 to 800. Does that make sense? Everybody kind of seeing that there? Yeah, I'd make about 40 bucks. Even if the market didn't move, because I'm able to buy lower than the market. See, up here I was buying higher than the market, right? So when I first opened this page, these probably looked really confusing to you, right? All these different spreads and different floors and ceilings and these different prices. But what do you see here? I can buy above where the market's at. I can buy right at where the market's at. I can buy below. Okay. ST, can you buy and sell immediately to be able to collect premium? No, you can't, because right now, if I bought this for $7.58, what can I sell it for right now? I can sell it for $7.54. So if I bought it and immediately sold it, I'd lose $4. But at expiration, what's the most I can make? If I'm buying, I can only make money up to the top. So it would have to expire at 17.8 or above, and I would make from 758 up to the 800. Does that make sense? No, don't be sorry, ST. It's a good question. Okay. Now, if I bought at 17,758 and the market went down to 7,759 and expired there, would I lose anything? No. Because what do I get at expiration? The difference of where I bought compared to where it expired. If I bought at 759 or 758 and the market did come down and it expired at 770, what would I make? 12 bucks, right? Does that make sense? So you can either pay premium, or you can collect premium, or you can get in right in the middle. Now some of you are saying, well, let's not pay premium, let's always collect premium. Okay, well, that's nice that you can make 40 bucks right there, right? If the market stays up. But what could you possibly make over here when you were paying a little premium? If the market went way up, you had a pretty high max profit, right? So do you see some of the pros and the cons? Do you see both sides to these different spreads here? It all depends on what you're wanting to do. If I think there's going to be a huge move in the market tomorrow, if I think it's going to be a huge move up, do I want to buy this spread here and worry about making 40 bucks? Or do I want to say, maybe I'll pay a little bit of premium and possibly make 300 bucks? Or maybe I want to get in dollar for dollar right away on one of these middle spreads if I think there's going to be a big move up. But if I think the market's going to stay up, but I don't expect a ton of movement, what could I do? I can just buy that one, right? I could. I mean, it all depends on your strategy or system. But you see how each spread has its own pros and cons, its own use, and why some days you don't want to choose a certain spread. You want to choose another one. Does that make sense? Sam says, how can we straddle spreads? Is it possible? Yeah, you can straddle spreads. I don't have a ton of time to get into it right now, Sam, because we're almost out of time. You can go over to the Apex website under the spreads section, and I do have a straddle video there. But basically how you would do that is right here. This is 17.8 going down, so you could sell this one, okay, because it's at the top going down 400, so you could sell it in case the market went down. At the same time, look, your top here of 17.8 is the bottom of this one, which means you could buy that one. So basically 17.8 is your middle point. You've sold to go down, and you've also bought to go up to see which way it goes. But you've got premium built in on both sides of that. So the market would have to move big enough to cover their premium on your other side. Okay? So, I mean, there's times where straddles are good when there's going to be huge moves or maybe news announcements, but just to randomly do them, you've got premium built in on both sides there, and you've got to overcome that premium, okay? Without knowing that it's going to be a big move, you might just be better off directionally so you don't have to cover the premium on the other side, okay? So I hope that helps put spreads into perspective. Let's look real quick before we go. Let's look at some Forex spreads that, let's look at pound yen, for example. Just these right here that open up at 7 p.m. They go to 9 p.m. tonight. Somebody said something about that earlier. Hey, this is great because we can trade spreads at night. You can trade spreads all night long on anything that Nadex offers overnight, and especially on Forex every couple hours. So it's the same thing right here. Where's the pound yen at? 156.09. 08. You can buy this one for 19, 112, 05. There's different spreads, different prices, different floors and ceilings. Okay? You know, that just gives you a perspective of, you know, the one we were looking at a few minutes ago on the Dow didn't expire till tomorrow afternoon. You know, we saw some higher premiums in some of those, like 50, right? 40 or 50. These aren't as much, you know, these are like, what, 4, 3, 9. You know, you're not going to have some of those at quite as high all the time on these, you know, ones that expire an hour or 2 hours or whatever. So that just helps you to know when you're trading spreads, don't just go in and get the cheapest spread available to you. off the bat. I'm not saying those aren't good spreads. Those are great spreads if they fit your proper strategy or system. Okay, but don't go in and just buy the cheapest one you can and then wonder why it didn't move for you dollar for tick. Okay, you got to see, yeah, exactly the same. You got to see the probability. Okay, James says, for a newbie to trade spreads, do you have a particular market you would recommend for a beginner? It's kind of hard for me to recommend a particular market to you. You know, and technically I can't even recommend one. All I can say is this. For a newbie trader in general, you know, you might want to, you know, what I wouldn't recommend for a newbie trader is to jump in trading gold or oil or, you know, natural gas, you know, something that moves like crazy, okay, and that can be really extremely volatile. You know, I would tell you, you know, to maybe start with something that's a little slower or something a little easier to understand. I like the Dow, and the Dow is not even slow. The Dow can move a lot, but it's very easy to understand. You know, it ticks in, you know, ones. It doesn't tick in like quarters or 0.10 or 0.1 and confusing. It's very easy to understand. You know, if you're trading Forex, you know, I know a lot of people like to trade the euro dollar. It's pretty easy to understand, a little slower. I love pound yen myself. Pound yen moves quite a bit at night and in the mornings. Pound yen's probably one of my, out of all the Nadex Forex pairs, pound dollar and pound yen are probably my favorite because you get some good movement out of them at night. You know, especially if you're an evening trader. You know, I mean, think about it. This time of night right now, it's almost 8 p.m. Eastern. Is the Dow moving right now? I mean, are the U.S. stock indexes moving right now? No, not really. What's open? What just opened and just is opening right now? Australia and what? Japan. The Nikkei is about to open, right? So what do you think would be, you know, opening or would have some good movement on it? Aussie pairs, yen pairs, Aussie yen, Aussie dollar, pound yen, dollar yen. You know, so you can get some decent moves at night and some good trades at night. Overnight in the middle of the night, you know, U.S. is not open yet. Japan and Australia are kind of coming towards their end, but what's opening about 3 a.m.? Boom, here comes all of Europe, right? Here comes your euro pairs, here comes your pound pairs. I mean, you've got stuff around the clock to trade, and it's great, especially with these spreads. You know, I mean, just pull up. I think I even have a, yeah. I mean, look at pound yen. This is just today. I mean, look at this morning on pound yen. What was it at down here? 155.52. Boom. 156.52. I mean, boom. There's 100 pips. There's 100 bucks right there on one spread, just from 6 o'clock to 8 o'clock this morning on pound yen. I mean, middle of the night when Europe was opening up, I mean, it had a move here from what, 67 to, you know, about 40 pips there, and then 156, 04, 155, you know, 60 down. I mean, that thing moves. I mean, you can see it right there. The thing moves, and it moves good. One of my favorite pairs. Okay, so plenty of good stuff there. So hope that helped a little bit tonight to help you really see the difference of spreads, and make sure to demo trade them. You know, don't just hop in and use the cheapest one out there. Make sure you're using the right spread for the right strategy. Again, hop on over to nadex.com. Make sure to get a demo account. You can also hop on to Nadex there and go under the webinar archives and catch up on any of the last few webinars you might have missed there. And again, hop on over. A couple of you are asking about other webinars and markets and strategies and systems. Hop on over to our website, apexinvesting.com. Sign up for a free username and password. You'll see on the main page there under education, I've got it broken down of, you know, stocks, Forex, Nadex spreads, Nadex binaries. Go to Nadex spreads. It'll go through. There's a step-by-step training course on spreads. There's 4 or 5 different strategies and systems we use to trade spreads. We show you live trades, exactly how we trade them, charts, indicators. Everything you would need to know is right there. Exactly all the different things you can want to know about spreads, different strategies and systems. We have a free spread scanner that you can go to. You know, like right here, remember where I was showing you, okay, I can look at these spreads from 6 to 11, and there's all these different spreads available, and then, you know, the 6 to 8 p.m. spread. Like, there's all these different spreads you got to keep clicking back and forth on. We have a free scanner that you can take advantage of that'll basically, and for binaries and spreads, but like it'll break down all the spreads for you on one page, showing you all the different spreads available, what you can buy them and sell them for, show you the risk and reward right here. See the green? Obviously that's potential reward. The risk, what you got to put up, is in red. You don't have to click and open a ticket and fill out information to get all that. It shows it to you all on one page. That's absolutely free for you guys to use. So hop on there and check that out. So again, go to nadex.com, get a free demo account. Hop on over to apexinvesting.com, get a free username and password. Check out some of those free tools. Ezra, how do I calculate how a spread is priced when it's out of the money in comparison to the underlying? Ezra, I'm not really sure to answer that. That's kind of what we've been talking about all night here. If you're looking at a spread, maybe tell me if I'm not understanding your question, but I mean, like we showed on the chart here, wherever the market is right now, you're not looking at where the market is now, you're looking at where you're buying the spread. Okay? Where is the spread priced at? And that's exactly what it will show you right here on, I mean, whether you're trading Forex or trading, you know, one of the indices. Looks like my demo account's stuck here. It will tell you right there. That's what you can't get hung up on. Where's the market right now when you're getting in? It's where are you buying in? Okay. Oh, you're talking about how they tick. Like I said, when they're out of the money like that, you know, they're normally going to tick at like 0.5, 0.6. Okay. Like 0.4 to 0.6, somewhere in there. Okay. As they get closer to where you got in, you know, they might click like 0.6, 0.7, but they're not going to be dollar for dollar until it catches up there. Okay, and that's not a standard, you know, that all depends on how far away they are, what's the IV and the options that day, the expected move of the market, you know, how far away is the price there. Okay. Yeah, there's no way of knowing that, Ezra. It all depends on the IV of options, and it can be anywhere from 0.4 to 0.6, you know, until it catches up to where you got in. Okay, that can vary based on the IV of options and how, you know, the implied volatility is pricing options that day. So, okay, guys. Well, thank you again for joining us tonight. Again, join us each and every Monday evening at 7 p.m. Eastern Time. Look forward to having you around with us next week. And just give it a day or two. This recording will be on the webinar archives there on the Nadex site. And again, hop on over to apexinvesting.com. Ask any questions over there. Let us know anything we can do to help you. And we will see you next week. Thank you so much. Thank you, Craig. We'll see you next week, man. Thanks a lot.